What's up, everyone? Today, we're diving deep into the world of growth ETFs. Listen, if you're looking to build serious wealth in the stock market, you can't just be putting your money in a savings account that earns you a measly 0.05% interest. That's like trying to outrun a cheetah on a tricycle. It's just not going to happen. Growth ETFs are like the espresso shots of the investment world. They're designed to give your portfolio that extra kick, that potential for serious returns that can turn your financial dreams into a reality. We're talking about owning a little piece of companies that are on the cutting edge, the ones disrupting industries and changing the world as we know it. But remember, just like that extra shot of espresso, growth ETFs come with a little more risk. They can be more volatile than your typical broad market index funds. But hey, if you're in it for the long haul, and you can stomach a few ups and downs along the way, these bad boys have the potential to make a huge difference in your portfolio over time. First up, we've got the Vanguard S&P 500 Growth ETF, also known as VUG. Now, I know what you're thinking. Mike, this is supposed to be about growth ETFs, not just your average S&P 500 fund. And you'd be right, but hear me out. The S&P 500 already has a built-in growth engine. It's made up of the 500 largest publicly traded companies in the US, many of which are already major players in growth sectors. Think about it. Companies like Apple, Amazon, Microsoft, these are the behemoths that have been consistently innovating and expanding for decades. They're the ones driving technological advancements, shaping consumer behavior, and let's be honest, they're probably the ones you're already interacting with on a daily basis. VUG takes this growth potential a step further by specifically targeting the companies within the S&P 500 that exhibit the strongest growth characteristics. We're talking about things like high revenue growth, strong earnings per share, and a forward-looking approach to innovation and expansion. Now let's talk numbers. Historically, VUG has delivered impressive returns. I'm talking double-digit returns in many years, consistently outperforming the broader S&P 500 index. And while past performance is never a guarantee of future returns, it does give us a pretty good indication of the potential this ETF holds. But here's the thing I love about VUG. It offers that growth potential with a relatively lower risk profile compared to some of the other, more specialized growth ETFs out there. See, because it's still tied to the S&P 500, you're getting a level of diversification that can help cushion your portfolio against major market swings. Think of it like this. VUG is like the reliable, fuel-efficient car that still manages to have some serious horsepower under the hood. It's not going to win any drag races, but it'll get you where you need to go consistently and reliably without breaking the bank on gas. So, if you're looking for a solid core holding for your growth portfolio, something that gives you exposure to the biggest and best growth companies in the US, VUG is definitely worth considering. It's a smart choice for those who want to balance growth with stability, ensuring that your investments are both forward-thinking and grounded in proven success. Alright, moving on to our next contender, the Schwab US Large Cap Growth ETF, or SCHG for short. This ETF is designed to provide investors with a diversified approach to growth investing, making it an attractive option for those looking to balance risk and reward. Now, this ETF takes a slightly different approach to growth investing, and it's one that I think is particularly well suited for those of you who are looking for a bit more diversification within your growth portfolio. Diversification is a key strategy in managing investment risk, and SCHG does this exceptionally well. See, while VUG focuses specifically on the S&P 500, SCHG casts a wider net. This broader approach can potentially capture more growth opportunities across different sectors and industries. It tracks the Dow Jones US Large Cap Growth Total Stock Market Index, which, as the name suggests, includes large cap growth companies from across the entire US stock market. This index is known for its comprehensive coverage of the market, providing a more holistic view of growth opportunities. This means you're getting exposure to a broader range of industries and sectors, which can be a huge advantage when it comes to managing risk. By spreading investments across various sectors, you reduce the impact of any single sector's downturn on your overall portfolio. Think about it. If one particular sector takes a hit, the impact on your portfolio is likely to be less severe if you're not overly concentrated in that one area. This is the essence of diversification, and SCHG embodies this principle effectively. And let's be real, diversification is key, people. It's one of the fundamental principles of sound investing, helping to mitigate risks and smooth out returns over time. It's like that old saying goes, don't put all your eggs in one basket. This wisdom is especially relevant in the world of investing, where spreading your investments can protect you from significant losses. Especially when it comes to investing, you want to spread your bets, diversify your holdings, and make sure you're not putting all your faith in a single company, sector, or even index. This approach can help you achieve more stable and consistent returns. Now, SCHG's focus on large-cap stocks is another factor that contributes to its stability. Large-cap stocks are typically more established and financially sound, providing a solid foundation for your investment portfolio. Large-cap companies are the established giants of the market, the ones with proven track records, strong financials, and the resources to weather economic storms. These companies are often leaders in their industries, offering a level of security that smaller companies may not. They're not going to triple in value overnight, but they're also less likely to experience the same level of volatility as some of the smaller, more speculative growth companies out there. This makes them a more reliable choice for long-term growth. It's like the difference between a seasoned marathon runner and someone who just decided to sign up for their first 5K. The marathon runner has the experience and endurance to go the distance, just like large cap stocks have the stability to perform well over the long term. And speaking of stability, let's talk about SCHG's historical performance. Over the years, this ETF has shown a consistent ability to deliver strong returns, making it a reliable choice for growth-focused investors. This ETF has consistently delivered impressive returns, often outpacing the broader market and even giving VOG a run for its money in some years. This track record of performance is a testament to its effective investment strategy. But here's the kicker. SCHG achieves this growth while maintaining a relatively low expense ratio. Lower fees mean more of your money stays invested, compounding over time to enhance your returns. We're talking about fractions of a percent, which might not seem like a big deal, but trust me, over the long term, those seemingly small fees can eat into your returns like a termite colony feasting on a redwood. Keeping costs low is crucial for maximizing your investment gains. So, if you're looking for a growth ETF that offers a bit more diversification, a focus on the stability of large-cap companies, and a history of impressive returns, SCHG is definitely worth adding to your watch list. It's a solid choice for those aiming for long-term growth with a balanced approach. Alright, now for the final ETF on our list, and this one's a bit of a wild card. We're talking about the Vanguard Information Technology ETF, or VGT. Now, as the name suggests, this ETF is laser-focused on the technology sector. We're talking about everything from software and hardware to semiconductors, cloud computing, artificial intelligence, you name it. If it's tech, chances are VGT has some exposure to it. Now, I know what you're thinking. Graham, tech is volatile. Remember the dot-com bubble? And you're right, the tech sector can be prone to some pretty wild swings, but here's the thing. Tech is also the engine of growth in the 21st century. Think about it. The way we live, work, communicate, consume entertainment, it's all being transformed by technology. And the companies at the forefront of this revolution, the ones developing the next generation of smartphones, the software that powers our businesses, the artificial intelligence that's changing the world as we know it, those are the companies that have the potential to generate truly outsized returns. And that's where VGT comes in. This ETF gives you direct exposure to that growth potential. It's like owning a small slice of the entire tech sector, allowing you to participate in the upside without having to pick and choose individual winners and losers. Now let's be real. VGT is not for the faint of heart. This is a high-growth, high-risk ETF. It's going to be more volatile than VUG or SCHG. There will be ups and downs, probably more so than with other, more diversified ETFs. But here's the thing. If you're investing for the long term, and you believe in the transformative power of technology, VGT has the potential to be a game changer for your portfolio. It's like investing in the California gold rush of the 1850s, except instead of panning for gold, you're buying into the companies that are shaping the future. But here's a word of caution. Because VGT is so heavily concentrated in one sector, it's crucial to make sure it's part of a well-diversified portfolio. You don't want your entire financial future riding on the performance of a single sector, no matter how promising it may seem. So, if you're looking for a high-growth, high-potential ETF that gives you direct exposure to the tech sector, and you're comfortable with a bit more risk, VGT could be a valuable addition to your portfolio. Remember, the key is to balance it with other investments to mitigate risk while still capturing the growth potential of the tech sector. So there you have it, 3 unstoppable growth ETFs that could help you crush your financial goals. Remember, growth ETFs can be a fantastic way to supercharge your savings, but it's crucial to understand the risks involved. Just like with any investment, it's essential to do your research, understand your risk tolerance, and make sure these ETFs align with your overall investment strategy. And as always, it's never a bad idea to consult with a financial advisor before making any major investment decisions. But with the right approach, these 3 ETFs could help you build a portfolio that generates significant wealth over time. So start investing today, and let the power of compound growth work its magic. If you've made it this far, please smash the like and subscribe button. It truly helps show the YouTube gods we mean business. I'll see you in the next video.